So I want to introduce you to my business partner. In about 5 minutes, your brain will start hurting because when you talk to this guy for more than 5 minutes, my lawyer says it, my team says it, everybody on my team says it. He overwhelms people like no one else. And I'm going to ask him to explain what the heck he does it. And my first question though, why do you overwhelm people?
Because it's called OCD, obsessive compulsive disorder. We don't control it. Everyone has a different percentage. And some people don't even get married. That's how bad it is, you know? So there's a few people out there that can't even have a relationship. I have just enough to give everybody enough of a headache, but be also of some utility to some people.
So we're here at the RoofCon. What do we do? What's the business today? What we're trying to accomplish next? What's the next milestone, next goal?
Well, this is a good question that you asked because honestly, we are at the precipice of fixing the problem, Dmitry. We know that the biggest pain factor for every contractor out there is what? They have a job, they need to obviously get it over the line, and it comes down to how you're gonna pay for it, right? Homeowner is either gonna get retail financing, they're going to try to do it through insurance, or I don't know, whatever else.
Financing is the biggest trending right now because people cannot afford roofs. People cannot afford to pay for shit anymore.
Even the insurance
Thanks, Biden.
Right, even they can't afford to pay for it. So we have a solution, and the idea is this. A contractor should be able to source funding without dealer fees. A homeowner should be able to get a loan, simple interest that they can pay back, not based on it. And if they get an insurance proceeds check, they can apply it towards it and then have that available to them if another storm hits them again.
So what's the goal? The goal is to raise funds to provide financing to the... Isn't it very risky to lend money?
It is if you are doing it under... See, if you're a bank, you can't lend people's deposits. That's the trickiest of all the money. Banks are not really in the position to be lending out a depositors money. They're just trying to keep it safe, right?
Yeah.
Hence the word of bank. When you get into that kind of capital, now you get into these structured instruments that are designed to raise capital. Now, if you're that investor says, hey, I want to put 10, 20, 40 million into this thing. I want a return. When people are making interest payments, those become constant, receivable, collateralized, so quote unquote safe, right? And they can always be repackaged and sold back into the market, or they can be kept for the interest benefits.
Can you elaborate and explain financial landscaping and construction? I see, I just talked to Chris Cavill. He's improv, very good player, and been in the finance world for 20 years. So he explained and showed me 5 good players. He's like, these 5 players are good.
Yeah.
But there's another 15 players who tried over the years to come to roofing industry to try this and failed miserably. Attorney generals prosecuting them. They're on the verge of bankruptcy. So Rich is getting richer. Top 5 players. It's your Wells Fargo. It's your Service Finance. Regions is pretty big player now.
Right.
So they're true banks and then lend money. They have private equity money behind them.
Right.
So those successful. Why others like Sunlight and others failing?
There's different lanes. When you are raising private capital, right? Like in the private equity market.
Like hedge fund?
Yeah. That is not regulated money. That is the general partner gets to decide how that's going to be used, and they are the authority on that, okay? Where you get in trouble is now you set up a lender entity that has consumer laws that you can't break. Remember, the money's going to go to consumers. You have to make sure that you're in compliance. Where you get into problems is if the guy or the gal or the team that set together, that formed the general partner, they start... No, the bottom line is this: if they're going to get paid their fees, they have to make the fund work. Sometimes to make the fund work, they force the equation. Now this lender is cooking the books, if you will, but not on the accounts. We're talking about the transactions. Just to push more volume, now you're funding things that shouldn't be fundable. Remember when we started this talking point, I said you need to be able to package them and sell them into the secondary market. That means they're clean. They can be sold off as packages. when you create that kind of garbage paper, you're not going to be able to sell it. So what you end up doing is you create an artificial bubble even within your own fund, and if you're regulated, now you're looking at an implosion, right? And that's exactly what happened over there. You've got a GP, and I don't know this because, again, this is just my opinion as these things go, but you got a GP that knew how to raise capital, but when it came time to actually operate the fund, if the fees for the GP are based on the performance and he is the one underwriting, now you can get yourself obviously into a corner.
How are you going to do things differently? Because financing still depends on people paying back mortgages. I mean, people don't pay back loans. We repossess cars. We foreclose on homes.
Right.
What's the protection? How are you going to protect yourself from lending money to?
The best way to protect yourself is not to be the one that has all the levers. For example, we can now talk about Mandelbrot, right? Mandelbrot, the way it's designed, in the case of directory, we've got contractors that are vetted, right? With a program that says to them, hey, listen, if the contract doesn't deliver, directory will come in and find someone that can finish the guarantee, the 20,000. That's a great contractor to use because at least there's some vetting and some guarantee. Now you've got software like Radiance that can say, hey, we can track every single dollar of where it's going, so when the actual fund participants look into it, they can say, oh yeah, I can see all the money operating, I can see how fast the recovery, the money's coming back. What you don't want to do as the GP is be the one that underwrites the actual loans. So within that document, if you will, you, in this case, Roofing Insights, the general partner, cannot be the one that actually underwrites. It has to be done, and it says it explicitly. The general partner will not be the one that underwrites these deals. So in plain English, because here we go with the 5-minute OCD overload. If everything is kept in a separate lane, you've got consumer law, you've got private capital, you've got different sources of income for the different entities. You can actually provide the homeowners with a reliable product. You can provide the investors of that fund, the credit investors. This is not for regular Joes, you know. Those individuals can have a healthy returns, and then the general partner can actually then be compensated based on the performance, but after a hurdle rate is met. And that happens through the natural compounding, but it takes time. You're not going to have that happen overnight.
Credit cards charge 20% to 30% interest rate. In finance world, it's 15, 20. That's what I see. On the low end, I see 9, 10. What's your expectancy for the rates for the homeowners?
Well, let's go back to the credit card. If the credit card is funded by a private capital source, it's going to have a higher interest rate because it's actually underwriting based on different criteria. If it's a credit card from a bank, you'll have a lower interest rate, but that's also because they're going off of depositor money, you know? In this scenario, what the market will bear, let's use the magic number 9, right? If a consumer that needs restoration work can get a loan for 9%, right, and can pay it back anytime, right, then that 9% doesn't sound like a lot, but imagine this, $100 million. $9 million comes in, lands on top of it. Now you got $109 million. Now 109 gets lent out. You see how it starts to compound?
6-7 years.
No, in fact, your compounding is not annual. It's when those loans are turning over. So the turnover ratio is either daily, weekly, monthly.
I see.
As those come in, they become new loans. So it's that turnover that creates that compounding effect. Now you're not yielding 9, you're actually yielding, you know, the numbers are doubling very quickly over the years that you mentioned. So that the solution is not complicated, it just has to be structured differently. And you cannot have one entity, like in the case of the GP, which you mentioned, that example, the reason they end up collapsing is because they're trying to control all the pieces. And you really want to decentralize that a little bit.
Got it.
Yeah. So, what did you think of Mandelbrot when you first saw it?
I like it. I'm just curious. Well, I think it's a very competitive product. I'm curious how complicated the back end is going to be. Because most finance companies, they have, for me, it's not about even two things when financing. One is
origination.
How much does it cost to the contractor, to the homeowner? But two, you need back-end onboarding and training process.
You're talking about the servicing.
Servicing.
There's two parts.
Yes.
The lender entity has two parts. The underwriting part is simply that. Underwrite it, see if this
Yes.
homeowner is viable for a truly $20,000 loan. Then when you transfer that over to servicing's job is to send an invoice, receive a payment, apply it to the principal, apply it to the
But
interest.
see, that's a lot of work.
Well, that's actually run through software. That's why you need the software part.
Yeah.
You know. Now, if someone doesn't pay, now you get into foreclosure. You turn it over to legal
Or
because
collections.
That's legal's job. Yeah. You know.
So what's your prediction on collections?
Well, collections in general. What sector?
Yeah, like how many will be in default?
Oh, you
It
mean
is-
the
yeah.
the
loans.
tolerance risk.
Yeah.
Okay. So let's take times like right now where we have high inflation, right? We know that more people default when they have inflationary times. But take a look at the math. Who's defaulting? Most people want to pay their mortgage because they don't want to lose their house. Most people have a low interest rate from before. So they don't want to refinance into something higher. So the propensity is that they want to keep what they have if it's better than what they could get. And if they lose it, they know they're going to end up in a horrible interest rate environment. So to answer the question in two parts, people want to take the path of least resistance, the least painful. And then when forced to do something, in this case that is going to cost them a bit more, it's only because they've already crossed that threshold. So in the case of the tolerance, when someone can't pay, that's where the underwriting kicks in. That's where the legitimate underwriting comes in, because now you have loans that are sellable as a package, as opposed to, you heard the word tranches, right?
Yeah.
Yeah. The ones that are performing are in one tranche. The ones that are defaulting in another tranche. Which ones are you going to sell? Which ones are you going to keep? You know? And at the end of the day, you've got recourse with them. So if you're a fund, you're going to keep the asset that comes with it. If it's going to be something you sell, you replenish money to do new loans on the new rate, new yield.
I want to take last minute and use it as a focus group. If you're the contractor and you're watching this, I want you to comment if you, one, offering financing and if you're happy with your finance provider, and two, if you're not offering financing, what's stopping you, or why you're not offering financing? Is it education? Is it because you don't know how to offer? Is it too complicated because you looked at it before and you have too many denials? What I've seen in past 5-6 years, and so many contractors have all these options, they sign up for them, start offering, and it just never sticks.
Well,
So-
it's two problems I've seen.
Yeah.
One, there's dealer fees
There's dealer fees.
that this
There's a-
structure that I'm talking about does not have dealer fees. The other part is to sign up for that lending program, they got to pay the lending program to make it available.
True.
Which both of them, in my opinion, are half-ass backwards, because if I'm bringing you a customer that's going to pay you interest, why am I paying you to?
Because that's the business model.
That's the current model right now.
Yes.
You know.
So we're gonna change it.
Yes.
But comment below your perfect, your ideal financing service that you would sign up today if that would be available. We read all our comments, and I
Yes.
want to know. Like, I came up with the business products from my comments. Comment below. What are you waiting for? What are you expecting for your finance companies to do? Another problem that I see is people getting overwhelmed with more tools, because
Right.
now it's another login,
Yeah.
it's another service to learn, it's another training they have to do with the sales guys.
Right. Yeah. Well, that gets into why we talk about Radians all the time. Radians is designed to say, look, stop all that disconnected nonsense. Get everything. You can keep what you have. Just get it all to work seamlessly through one interface. That's what OAuth was originally designed to do. Allow people to seamlessly log into everything in one. But how many times have I mentioned this word, commensalism? Everybody wants to do their own thing instead of throwing the switch and saying, okay, let's get on board with this mutualism stuff because it makes sense. If they have a login that gets them into all the systems, you already saw a couple of them are already switching. They're starting to change their attitude about interconnectivity. We need all of them to do it, because at the end of the day, if you've got a great service, people are going to use it anyway.
See, he does it again. Every time he starts using a lot of words with the isms,
Try.
socialisms, at the end, my brain started getting foggy. So we're going to stop it right now. Comment below what's your number one finance company in a perfect world would be, and what comment if your head was hurting a little bit as he was speaking. See you guys in the next video.
Thanks, guys.